In the first 3 months of this year, 7 out of every 10 major bankruptcies involved companies owned by private equity firms. Forever 21 collapsed under $1.5 billion in debt, 27,000 workers lost their jobs, 355 stores shuttered overnight. Joann declared bankruptcy twice within 12 months, 19,000 more layoffs, complete liquidation. Prospect Medical filed for bankruptcy owing more than $1 billion, while the private equity firm that owned it had already extracted $658 million in fees and dividends. 2 Pennsylvania hospitals are now closing, leaving an entire county with only 2 functioning medical centers. This video breaks down the $3 trillion shadow banking system that operates outside regulatory oversight, how leveraged buyouts are engineered to extract wealth and leave companies to collapse, and why this wave of bankruptcies could trigger the next financial crisis. By the end, you'll understand the mechanics behind these failures, which sectors are most exposed, and how to protect yourself before the dominoes fall. Stay until the final minutes, because I'll reveal the 3 private equity firms behind the most bankruptcies this year and the publicly traded companies in their portfolios right now that could be next on the chopping block. Let's start with the fundamentals. Private equity firms buy companies using borrowed money. That arrangement is called a leveraged buyout. Here's how it works. A private equity firm identifies a target company, often a mature business with predictable cash flows. Instead of using their own capital to purchase it outright, they borrowed the majority of the acquisition price. The debt doesn't sit on the private equity firm's balance sheet. It gets placed directly onto the company being acquired. Imagine buying a house, putting the mortgage in the house's name, and then charging the house rent for living in it. Sound insane? That's exactly what private equity does, and it's completely legal. Once the private equity firm owns the company, the extraction begins. The firm charges management fees for overseeing operations, advisory fees for strategic guidance, and consulting fees for services that may or may not materialize. These fees flow regardless of whether the company is profitable or losing money. Then comes the dividend recapitalization. The private equity firm forces the company to borrow even more money, not to invest in growth or upgrade facilities, but to pay dividends directly to the private equity owners. The company is squeezed for every possible dollar, while the private equity firm secures its returns long before any collapse becomes visible. The final phase involves cost cutting and asset stripping. Staff gets slashed, maintenance is deferred, research and development budgets evaporate, real estate gets sold in sale-leaseback transactions, converting owned property into long-term rent obligations that drain cash flow for decades. Then the private equity firm either sells the company to another buyer before the structure collapses or walks away through bankruptcy. Either way, the private equity firm has already recouped its initial investment plus substantial profits. The company, its workers, and the communities it served are left holding the bag. Why does this model work so effectively? Because private equity firms use other people's money. They raise capital from pension funds, insurance companies, university endowments, and sovereign wealth funds. These institutional investors are desperate for returns in a low-yield environment, so they allocate billions to private equity with minimal oversight. Limited liability protections mean that if the acquired company goes bankrupt, the private equity firm isn't legally responsible for the debts. Tax law allows interest payments on debt to be deducted, reducing the company's taxable income even as it struggles under crushing obligations. The system is designed to privatize gains and socialize losses. Now consider the scale. Private equity firms control more than $6.5 trillion in assets under management globally. In the United States alone, private equity-backed companies employ roughly 10% of the private sector workforce. Yet despite representing only 6.5% of the economy by revenue, private equity-backed firms accounted for 70% of large bankruptcies in the first quarter of this year. The year before, that figure was 54%. The trend is accelerating. Leveraged loan default rates have climbed to 7.6%, the highest level since the early days of the pandemic. These aren't isolated failures. They represent a systemic pattern where debt-fueled extraction leaves companies unable to survive even modest downturns. The mechanism behind this crisis lies in the broader shadow banking ecosystem. Over the past decade, private credit markets have exploded. Traditional banks, constrained by post-financial crisis regulations, pulled back from risky lending. Private credit funds stepped in to fill the gap. Today, the private credit market holds somewhere between $2 and $3 trillion in outstanding loans. Projections suggest that figure could reach $2.8 trillion by the end of next year. These loans fund leveraged buyouts, refinance existing debt, and provide working capital to companies that can't access public bond markets. Here's the problem. Private credit operates entirely outside the regulatory framework governing banks. There are no reserve requirements, no stress tests, no transparency mandates. Fund managers disclose minimal information to regulators and nothing to the public. Nobody knows which companies hold the riskiest debt, how much leverage is embedded in the system, or where contagion could spread if defaults accelerate. The Boston Federal Reserve published a report titled, "Could the growth of private credit pose a risk to financial system stability?" The answer, based on their analysis, is yes, yet regulators have no tools to monitor these markets in real time, let alone intervene when trouble emerges. Now here's the part that should terrify you. This $3 trillion system operates in complete darkness. No regulator knows which companies are drowning in debt. No pension fund knows if their retirement savings are funding the next collapse. And when one company fails, nobody can can trace where the contagion spreads. It's a financial black box, and it's about to crack open. Within the private credit market, a particularly dangerous instrument has gained traction. Payment-in-kind loans, known as PIK loans. These allow borrowers to defer cash interest payments and instead add the accrued interest to the principal balance. On paper, the loan keeps performing. In reality, the company generates no cash to service its obligations. The debt grows larger every quarter, and the eventual reckoning becomes more severe. When economic conditions tighten and refinancing becomes difficult, PIK borrowers are often the first to collapse. Yet private credit funds have been issuing PIK loans at an accelerating pace, driven by the need to deploy dry powder and earn fees on committed capital. Industry sources estimate that over $560 billion in uninvested capital is waiting to be deployed, creating pressure to lower underwriting standards and chase riskier deals. Jamie Dimon, the chief executive of JPMorgan Chase, has publicly warned that private credit could become the focal point for contagion in the next downturn. When he warns about something, you listen, because JPMorgan sees the exposures nobody else can see. And they're terrified. His concern is that when defaults begin, the opacity of the market will prevent accurate assessment of exposure. Pension funds and insurance companies hold substantial allocations to private credit, but they often don't know the underlying borrowers or the terms of the loans. If private credit funds start gating redemptions or writing down asset values, those institutional investors could face liquidity crises of their own. Pensioners depending on stable returns could see benefits cut. Insurance policyholders could face solvency concerns. The ripple effects would extend far beyond Wall Street. Now let's examine specific bankruptcies to understand the pattern. Forever 21 was acquired by a consortium that included private equity firms and other investors. The company was saddled with $1.5 billion in debt. When consumer spending shifted toward ultra-fast fashion competitors and the debt burden became unsustainable, Forever 21 filed for bankruptcy. 355 stores closed, 27,000 jobs vanished. The private equity investors had already extracted fees during their ownership period. The workers and mall landlords bore the losses. Joann's story is even more extreme. Owned by Leonard Green and Partners, Joann filed for bankruptcy once, emerged briefly under a restructured capital structure, and then filed again less than a year later. The second bankruptcy resulted in complete liquidation. 19,000 employees lost their jobs. Suppliers were left unpaid. The company couldn't survive the debt load imposed during the leveraged buyout. Leonard Green had long since recovered its investment through fees and dividends. Prospect Medical illustrates the human cost. Leonard Green bought the hospital chain, loaded it with debt, extracted $658 million, and sold it to another buyer. The hospitals continued to deteriorate under the weight of the debt and deferred investments. Eventually, Prospect filed for bankruptcy. 2 hospitals in Pennsylvania are now closing. Delaware County will be left with only 2 functioning hospitals serving a population of over 500,000. State representative described the situation bluntly. These hospitals were ransacked, robbed, and plundered for profit. Patients, healthcare workers, and entire communities paid the price while private equity walked away rich. Leonard Green and Partners is just one firm. The Container Store, another Leonard Green investment, filed for bankruptcy late last year. Mittel Networks collapsed. DocuData went under. Zips Car Wash filed for protection. The pattern repeats across industries: retail, healthcare, business services, telecommunications, consumer discretionary. Each bankruptcy follows the same script: leverage, extraction, collapse. Zombie companies represent another layer of risk. These are firms that generate enough revenue to cover operating expenses, but not enough to service their debt from cash flow. They survive by rolling over maturing debt or borrowing additional funds to make interest payments. As long as credit markets remain open and lenders are willing to refinance, zombies limp along. But when credit conditions tighten or interest rates rise, refinancing becomes prohibitively expensive or impossible. The zombie collapses. The United States has accumulated a massive population of zombie companies under private equity ownership. These firms are ticking time bombs waiting for the next credit shock. The bankruptcies I just showed you, they're the tip of the iceberg. The maturity wall hasn't even hit yet. When it does, entire sectors will collapse. Stay with me because I'm about to show you which industries are sitting on a powder keg right now and how to check if you're exposed. Which industries are sitting on the fault lines right now? Retail has been devastated. The sector faces structural headwinds from e-commerce competition, shifting consumer preferences, and rising labor costs. When you layer crushing debt onto companies already fighting for survival, bankruptcy becomes inevitable. Retail accounted for the largest share of private equity-linked failures in recent quarters. Dozens of smaller chains have quietly liquidated or closed significant portions of their footprint. Commercial landlords are left with vacant anchor stores. Shopping malls lose traffic, local tax bases erode. The damage spreads concentrically from each failure. Healthcare services represent another high-risk category. Hospital systems, nursing homes, and outpatient clinics require constant capital investment to maintain facilities, upgrade equipment, and retain qualified staff. Private equity ownership often prioritizes short-term cash extraction over long-term sustainability. Communities lose access to emergency care. Patients face longer travel times. Healthcare workers lose jobs and pensions. The consequences are measured not just in financial terms, but in lives affected and outcomes compromised. Business services and telecommunications have also seen elevated bankruptcy rates among among private equity-backed firms. These sectors depend on technology investments to remain competitive. When private equity owners defer IT upgrades, cut research budgets, and squeeze margins to maximize dividends, the underlying business loses its competitive edge. Clients defect to better capitalized rivals. Revenue declines. The debt burden becomes unsustainable. Both companies served corporate clients who demanded reliable, modern solutions. Both fell behind technologically under private equity ownership. Both ultimately collapsed. Consumer discretionary businesses like car washes, gyms, and entertainment venues operate on thin margins and depend on steady foot traffic. Economic downturns hit these sectors hard. When combined with high leverage, even minor revenue declines can trigger covenant breaches and force restructuring or bankruptcy. Companies in this category couldn't weather the combination of labor cost inflation, reduced consumer spending, and debt service obligations. Real estate services face a perfect storm of challenges. Commercial real estate vacancy rates remain elevated, particularly in office properties. Demand for traditional office space has structurally declined as remote work becomes permanent. Property management companies, leasing agencies, and facility services firms tied to commercial real estate are under intense pressure. Many of these businesses were acquired through leveraged buyouts during the pre-pandemic boom. Now they're servicing debt based on revenue projections that will never materialize. Defaults are rising, more bankruptcies will follow. This isn't just about stocks and bonds. Every bankruptcy destroys lives. Workers lose jobs, communities lose hospitals, families lose savings, and private equity walks away richer. The human cost is staggering, but it never appears in the quarterly earnings reports or investor presentations. The maturity wall creates urgency across all these sectors. A massive wave of high-yield bonds and leveraged loans is maturing between now and the end of next year. Companies that borrowed heavily at low rates must now refinance at significantly higher costs. A firm that could service debt at 4% interest may find refinancing at 7 or 8% impossible. Cash flow that was barely sufficient becomes catastrophically inadequate. The choice becomes default or inject fresh equity. For over-levered private equity-backed companies, fresh equity is often unavailable. Existing investors have already written down their stakes. New investors see a balance sheet loaded with debt and declining revenues. The company enters bankruptcy and the cycle completes. You might think you're safe if you don't own these companies directly, but here's what nobody tells you. Your pension fund almost certainly does. And when these companies collapse, it's your retirement that vanishes. I'll show you exactly how to check your exposure in the next few minutes. How can you identify private equity-backed companies in your own portfolio? Right now, at this moment, you could be holding companies on the brink of collapse without knowing it. Check your portfolio tonight. Look up the ownership. If you see Leonard Green, Sycamore, or Sun Capital, you need to understand what you're exposed to, because when these companies file for bankruptcy, your shares become worthless overnight. No warning, no second chance, just gone. Start by checking the ownership structure of any company you hold directly or through mutual funds and exchange-traded funds. Major financial websites disclose significant shareholders. If a private equity firm holds a majority stake or sits on the board, the company warrants closer scrutiny. Look at the company's debt levels. Debt to EBITDA ratios above 5 times earnings indicate aggressive leverage. Interest coverage ratios below 2 times mean the company is barely generating enough cash to cover interest payments, let alone principal repayment. These are red flags screaming danger. Imagine you owned bonds in a company that seemed safe, paying 5% annual interest, then bankruptcy hit. Bondholders recovered 15 cents on the dollar. An investment of $10,000 became $1,500. That's not a correction. That's annihilation. And it happens faster than you can react. Examine cash flow statements carefully. If a company is paying large dividends to shareholders while generating negative free cash flow, wealth is being extracted rather than reinvested. Sale-leaseback transactions, where the company sells real estate it owns and leases it back long-term, often signal liquidity stress and short-term thinking. Asset sales that don't result in debt reduction or reinvestment suggest the proceeds are being funneled to equity holders rather than strengthening the business. Pay attention to management turnover. Private equity firms often install new executives who prioritize financial engineering over operational excellence. Frequent changes in leadership, particularly when combined with cost-cutting initiatives and declining employee morale, indicate a company under stress. Employee reviews, industry forums, and trade publications can provide early warnings that a company's culture is deteriorating under private equity ownership. Sector exposure matters as much as individual company analysis. If you hold significant allocations to retail, healthcare services, business process outsourcing, or consumer discretionary sectors, recognize that these industries have elevated bankruptcy risk among private equity-backed firms. Diversification across less levered sectors, technology companies with strong balance sheets, industrials benefiting from infrastructure spending, or commodity producers with tangible assets can reduce overall portfolio risk and protect you when the wave hits. Now, let's talk about the publicly traded private equity equity firms themselves. Blackstone, KKR, and Apollo are the largest players in the industry. Their stock prices reflect investor sentiment about the health of their portfolios and the broader private equity ecosystem. Recent months have seen these stocks decline by double-digit percentages. The biggest players are already bleeding, but here's the terrifying part. The maturity wall hasn't even hit yet. When it does, the bankruptcies we've seen will look like a warm-up. Investors are pricing in the risk that rising defaults will reduce asset valuations, lower management fees, and impair carried interest. If you own shares in these firms or hold them through index funds, understand that you're exposed to the same dynamics driving the bankruptcy wave. The secondary effects of this crisis extend beyond financial markets. Pension funds allocate substantial portions of their portfolios to private equity, chasing returns to meet obligations to retirees. When private equity funds write down assets or gate redemptions, pension funding ratios deteriorate. State and municipal pension systems, already underfunded in many jurisdictions, could face calls for benefit cuts or taxpayer bailouts. Insurance companies, which hold private credit and private equity investments to generate yield, may see their capital bases erode if defaults accelerate. Policyholders could face premium increases or reduced coverage. The financial fragility spreads through institutions that most people assume are safe and stable. Employment impacts are immediate and severe. Over 65,000 jobs were lost in the first quarter alone from private equity-linked bankruptcies. That figure counts only large-scale layoffs reported publicly. Smaller closures and gradual headcount reductions add thousands more. Workers lose not only paychecks but often health insurance, retirement savings, and severance packages when companies liquidate rather than reorganize. Communities that depend on a single large employer face economic devastation when that employer collapses under private equity ownership. Public services suffer when tax revenues decline. Municipalities that hosted retail chains or healthcare facilities lose sales tax, property tax, and business license fees. Budgets shrink, schools, police, and infrastructure maintenance face cuts. The economic damage compounds over time, creating blighted commercial corridors and reducing the attractiveness of the area for future investment. Private equity profits are privatized, but the costs of failure are socialized across workers, communities, and taxpayers. The wealth extraction enriches a handful of fund managers, while entire regions suffer long-term declines. Here's the retention moment you need to absorb. The private equity industry is not slowing down. Despite rising bankruptcies, despite regulatory warnings, despite public criticism, private equity firms are raising record amounts of new capital and continuing to pursue leveraged buyouts. Why? Because the incentive structure rewards deal flow and fee generation, not long-term value creation. Fund managers earn fees based on assets under management and deals completed. They earn carried interest on profits realized during their investment period, typically 5 to 7 years. What happens to the company after the private equity firm exits is someone else's problem. This misalignment of incentives guarantees the cycle will continue until external forces, regulation, credit market collapse, or sustained public pressure intervene. And right now, none of those forces are strong enough to stop it. The three firms I'm about to name have destroyed more companies than any others. Leonard Green, Sycamore, Sun Capital. They've perfected the playbook: leverage, extract, collapse, and they're buying new companies right now. Stay with me because I'll show you which companies in their portfolios are flashing red warning signs and what you can do to protect yourself before it's too late. Leonard Green and Partners stands out as the firm behind the highest concentration of recent bankruptcies. Joann, bankrupt twice within a year. Prospect Medical, hospitals closing while executives walked away with hundreds of millions. The Container Store liquidated after decades in business. This isn't bad luck or poor timing. Leonard Green's playbook follows the same pattern across portfolio companies. Aggressive leverage, maximum extraction, minimal reinvestment. The firm loads companies with debt, strips out cash through dividends and fees, and exits before the structure collapses. Workers, creditors, and communities bear the losses. Leonard Green has earned billions in profits over the years by perfecting this model, and they're still actively acquiring new companies today. Sycamore Partners represents another prolific player in the bankruptcy space. Staples, Belk, and Talbots all entered restructuring under Sycamore ownership. The firm specializes in retail acquisitions, buying mature brands with established customer bases and extensive real estate portfolios. The strategy involves sale-leaseback transactions to extract value from owned properties, dividend recapitalizations to return cash to Sycamore, and operational cuts to boost short-term margins. When consumer preferences shift or economic conditions tighten, these companies lack the financial cushion to adapt. Chapter 11 becomes the inevitable outcome. Sun Capital Partners rounds out the top three firms associated with repeated bankruptcies. Boston Market, Friendly's, and multiple other restaurant and retail chains collapsed under Sun Capital ownership. The firm targets struggling businesses trading at distressed valuations, acquires them with borrowed money, and attempts operational turnarounds. Sometimes these turnarounds succeed, often they don't, particularly when the underlying business model faces structural decline. Sun Capital has faced lawsuits from creditors alleging fraudulent transfers and asset stripping. Courts have occasionally ruled in favor of creditors, forcing Sun Capital to return extracted funds. But did that stop them? No, they're still operating, still buying, still extracting, because nobody has the power or the will to shut them down. Now let's identify specific companies in these firms' portfolios that exhibit the warning signs we've discussed. While I can't predict bankruptcy with certainty, several portfolio companies show multiple red flags. Check ownership disclosures and financial filings for companies in sectors with high private equity bankruptcy rates: retail, healthcare services, consumer discretionary. Look for debt to EBITDA ratios above 5, interest coverage below 2, negative free cash flow, and recent dividend recapitalizations or sale-leaseback transactions. Cross-reference those companies with private equity ownership by Leonard Green, Sycamore, Sun Capital, or similar firms with track records of extraction-focused strategies. The systemic risk that could turn this crisis into full-scale contagion lies in the interconnectedness of private credit, pension funds, and insurance companies. Private credit funds have lent trillions to private equity-backed companies. Those loans are funded by capital raised from institutional investors, including public pension systems and insurance companies. When defaults accelerate, private credit funds will face losses. They may gate redemptions to prevent runs, trapping investor capital. They'll mark down asset values, reducing reported returns. Pension funds that assumed 8% annual returns from private credit will suddenly realize 3 or 4%, or even negative returns in severe scenarios. Underfunded pension systems will face acute pressure. Funding ratios will decline further. States and municipalities will confront difficult choices: cut benefits, raise taxes, or request federal bailouts. Each option carries political and economic consequences. Benefit cuts harm retirees who depend on fixed incomes. Tax increases dampen economic activity. Bailouts transfer private losses onto taxpayers and expand public debt. There are no painless solutions once the crisis cascades through the system. Insurance companies face similar dynamics. They allocate portions of their investment portfolios to private credit and private equity to generate yield in a low-rate environment. Losses in these allocations reduce capital ratios. If capital falls below regulatory minimums, insurance companies must raise fresh capital, cut dividends, or curtail underwriting. Policyholders face premium increases. In extreme scenarios, insurers could become insolvent, triggering state guarantee funds and potential taxpayer backstops. The financial contagion spreads from corporate bankruptcies to institutional investors to public finances and household balance sheets. Credit markets could seize if fear spreads. When this dominoes, it won't be slow. Credit markets will freeze, pension funds will gate, insurance companies will teeter, and by the time financial media starts covering it, your portfolio will have already been destroyed. Investors in leveraged loans and high-yield bonds will demand higher risk premiums. Spreads will widen. Companies attempting to refinance will face prohibitive costs. A wave of defaults becomes self-reinforcing. Healthy companies with near-term maturities get caught in the liquidity crunch. The distinction between distressed borrowers and merely over-levered borrowers blurs. Credit availability contracts across the board. Economic growth slows as businesses pull back on investment and hiring. The feedback loop between financial stress and real economic activity accelerates. Regulators face a dilemma. Private credit operates outside traditional banking oversight. Agencies lack real-time data on exposures, borrower quality, and interconnections. By the time stress becomes visible, the crisis has already metastasized. Attempts to impose regulation face intense lobbying from the private equity and private credit industries, which argue that oversight would stifle innovation and reduce returns to pension beneficiaries. This argument holds sway with policymakers reluctant to interfere with capital markets. Regulation arrives late after the damage is done, if it arrives at all. What can you do to protect yourself? Begin by auditing your portfolio exposure to private equity-backed companies and private credit. If you hold individual stocks, research ownership structures and leverage ratios. Avoid companies in high-risk sectors with private equity ownership and debt levels above 5 times EBITDA. If you invest through mutual funds or ETFs, review holdings and sector allocations. Funds concentrated in retail, healthcare services, or consumer discretionary may carry elevated risk. Consider shifting towards sectors with lower leverage and stronger fundamentals. Technology companies with fortress balance sheets, industrials benefiting from infrastructure spending, or commodity producers with tangible assets and pricing power. For those exposed through pension funds, engagement is critical. Attend pension board meetings, request transparency on private equity and private credit allocations. Demand stress testing that models the impact of rising defaults. Advocate for prudent asset allocation that doesn't chase yield at the expense of safety. Pension trustees have fiduciary duties to beneficiaries. Hold them accountable for investment decisions that prioritize long-term sustainability over short-term returns. Monitor credit spreads and default rates as early warning indicators. Rising spreads signal that investors are demanding higher compensation for risk. Increasing default rates confirm that stress is materializing. If both trends accelerate simultaneously, the credit cycle is turning. Defensive positioning becomes prudent. Reduce exposure to high-yield debt. Increase allocations to cash, short-duration bonds, or inflation-protected securities. Consider gold or commodities as hedges against financial instability and currency debasement. Understand that this crisis unfolds gradually. Then suddenly, defaults trickle in, garnering limited attention. Media coverage focuses on individual company failures rather than systemic patterns. Then a high-profile bankruptcy triggers broader scrutiny. Investors reassess risk. Capital flees. The trickle becomes a flood. By the time consensus recognizes the crisis, asset prices have already adjusted. Proactive positioning before the crowd panics separates those who preserve capital from those who suffer permanent losses. The private equity model isn't inherently destructive. Well-executed leveraged buyouts can unlock value by improving operations, entering new markets, or streamlining costs. Some private equity firms prioritize long-term value creation over short-term extraction. Those firms earn sustainable returns and build reputations for responsible stewardship. The problem arises when misaligned incentives, excessive leverage, and regulatory gaps enable wealth extraction at the expense of company survival. The industry's worst actors exploit these conditions repeatedly, leaving a trail of bankruptcies, job losses, and community devastation. Until incentives change, the cycle continues. Private equity has weaponized leverage to extract wealth from companies, workers, and communities. 70% of major bankruptcies this year involved private equity-backed firms. $3 trillion in shadow banking debt sits outside regulatory view. The maturity wall is here. Refinancing pressures are intensifying. Defaults are accelerating. Leonard Green, Sycamore, and Sun Capital are just 3 firms among hundreds executing similar strategies. The bankruptcies you've seen are not the end. They're the beginning of a wave that will crest over the next 18 months. So here's my question. If private equity destroyed 70% of major companies that went bankrupt this year, why are we still letting them buy more? Why are pension funds handing them billions? Why do regulators turn a blind eye while hospitals close and workers lose everything? Drop your answer below, because if you're not angry yet, you're not paying attention. Here's what I want to know. How many more collapses will it take? How many more hospitals have to close? How many more workers have to lose their jobs before we admit this system is designed to extract wealth, not create it? Tell me in the comments if you think I'm wrong, because 2 years from now, when the maturity wall has fully hit and bankruptcies have multiplied, I'll be back to see who was right. If this analysis opened your eyes to the private equity time bomb, share it with anyone invested in the market. Subscribe for breakdowns of the financial forces reshaping the economy. Check your portfolio exposure today. The next wave of bankruptcies won't wait for you to be ready. Thank you for watching.